next slide is let's define qualified business income. What was the difference in this slide and the prior slide? The prior slide, we were defining what a trader business is. It raises to the level of 162. So that's the first thing we have to do. The second step we have to do is define what is income from that qualified trade or business. Well, the definition here on this slide is actually the definition that's in the code. Stay with me, because I think out of this I can kind of help you. This particular sentence here, when the law first came out, there was all kinds of articles, all kinds of interpretations. National organizations were in position of what the definition should be. And I'll just be very candid. I got to looking at this and I said, by the way, I've seen this before. What is the law before this was passed? Well, if I go to the Internal Revenue Code that's been around, our current one was originally totally redone in 1954. In the area of a Schedule C, or in the area of partnership or corporate law in the Internal Revenue Code, this exists. Then I got to looking at my clients. When we go to do a business return, we want to see their LLC operating agreement, we want to see their partnership agreement, we want to see their bylaws of the corporation. And what I got to looking at, most of the state laws have incorporated this phrase right here. So I'm from the state of Missouri. So I got to looking, here's an LLC operating agreement. This exact phrase is in there. So I found it in the code in more than one place. I have found it in operating agreements. I found it in bylaws. So there must be a whole history. There's decades of history. Know the law. So if I knew the law before 199A in December of 19, guess what? It's nothing new. But let's go through this. So let's go through what's been with us on doing a tax return for decades. So let's dissect this sentence. It says the net, okay? Net means after, all items of income, gain, deduction, and loss with respect to a qualified trade or business. Well, the qualified trade or business, that item right there, and let's do this. That green circle there is a qualified trade or business. See, that was our last slide. So we know what that is. It raises to the level. Well, so we got the qualified trade or business. If it's items of income, gain, deduction, or loss, the net of those items is our QBI that we're going to get 20% on. So now let's back up and look at what each one of those items mean. If you've got a Schedule C, what happens is we've got income at the bottom. It says net income. If you've got LLC partnership, it comes down to a net income. Let's go. So let's put a check mark there. Okay. Let's go to the next one. Let's go to the word gain. Notice it didn't say what kind of gain, because what we're going to find out, see, a capital gain is not an income from a trade or business. If I sell a business, I'm going to get capital gains. That's not from the activity. That's not the continuous and regular, as we learned on the prior slide on what's a qualified trade or business. So what this gain means, and I just want to put a line up here, and for those of you that have done taxes, because some people watching this may only be doing their own tax return, I'm going to put here a 4797. That's a form. That's an IRS form. And if you look up that form, if you want to Google it, the 4797 is the sale of an asset used in a trade or business. That doesn't go on net profit from the Schedule C, trade or business. It doesn't go on net income from the S Corp. It doesn't go on net income from the partnership. It's a separate stated item that doesn't go on the business part, but it goes over on the form 4797, an asset from the sale. What happens is if we know the old law, form 4797, it's to, in effect, it came out, I believe, in 1968, but it's actually to calculate whether there is any recapture of depreciation. Or another way to say it, recapture means ordinary income. So what happens with ordinary income, you don't get capital gain. So the way the 4797 works is that when you sell your asset used in a trade or business, again, it goes to this form, and we look to see if we have any ordinary income from the asset used in the trade or business. So what happens with that, if there is ordinary, it stays on the 4797, as you know, knowing the law, and it goes from the 4797 to the front page of the taxable income on that 1040. There's no capital gain. But if, let's say you sell something that you recaptured or depreciation, or it's real property where there is no recapture, then that gain doesn't stay on that 4797. This is old law, has nothing to do with QBI. It goes over to the Schedule D. What's the Schedule D? Everybody knows. It's a capital gain. You go to Schedule D, that's what it is, capital gains. And in that light, that doesn't get qualified here because, so back to this, it's ordinary income, ordinary gain, ordinary deduction, and ordinary loss. It's ordinary. So if you just know in the old law, before 199A came out, if you just apply the law, you already know. If you hear, or it's qualified as ordinary, or another way of saying it, if you don't get capital gains and it's related to that trade or business that has raised to the level of a trade or business, for example, again, not a hobby, then you get that income or deduction, that net, back to the very first term right here, the net of these items on that trade or business is your qualified income. So, and also the other thing I want to point out, it has to be within the United States. You can't be in a foreign country, you can't have income in a foreign country and qualify it for this. It's not a qualified trade or business.